Something very important just happened in the precious metals market. And it didn't come from a YouTuber. It didn't come from social media. It didn't come from a silver bull screaming about manipulation. It came from BNP Paribas, one of the largest banks in the world. And what they're saying should make everyone pay attention. Because according to BNP Paribas' head of Commodities Strategy, David Wilson, gold is now being driven toward $5,000 per ounce, far faster than anyone expected. While silver, even as it surges toward $100, could be setting up for a sharp sell-off right after. That contrast matters. And today, we're going to break down exactly why. Gold is doing what gold always does in crisis. David Wilson put it simply, gold thrives on uncertainty. And right now, uncertainty is everywhere. Not just economic uncertainty, not just inflation uncertainty, but political, institutional, and monetary uncertainty, all at the same time. According to BNP Paribas, gold's surge isn't being driven by hype. It's being driven by new catalysts that didn't even exist a few months ago. The two new catalysts driving gold higher. The first catalyst is geopolitical, specifically Trump's Greenland tariffs. Regardless of political views, markets understand one thing very clearly. Tariffs create instability. They distort trade, they raise costs, and they increase geopolitical friction. Gold loves that environment. The second catalyst is even more dangerous. Concerns about the independence of the Federal Reserve. This is critical, because gold isn't just reacting to inflation anymore, it's reacting to trust. Trust in the system, trust in central banking, trust in policy stability. When markets begin questioning whether the Federal Reserve can act independently, gold doesn't hesitate, it reprices higher. Why $5,000 gold is no longer. Extreme. Here's the part that should really make people stop and think. BNP Paribas first forecast $5,000 gold back in November. At the time, it sounded aggressive, almost unbelievable. Now, gold is already trading near $4,700. That puts $5,000 just $320 away. As David Wilson said, $5,000 is not much of a stretch right now. That's not hype, that's math. And BNP Paribas is now openly admitting they may have to raise their gold forecast even further for 2026. That's institutional language for, we underestimated how bad uncertainty is getting. Gold has every tailwind, working at once. This is what makes the gold move so powerful. According to BNP Paribas, every major support mechanism for gold is active at the same time. Geopolitical instability, monetary policy uncertainty, dollar vulnerability, safe haven demand, institutional allocation, central bank credibility concerns. This isn't a speculative rally. This is a repricing of risk. And when that happens, gold doesn't move in small steps. Why gold and silver are not the same trade. Now this is where things get interesting. Because while gold is being treated as a pure safe haven, silver is not. Silver is a different animal. David Wilson made that very clear. Silver is thinner, less liquid, more volatile. And that means silver behaves very differently once momentum shifts. Why silver went parabolic in the first place. Let's rewind. Silver didn't just go up for no reason. According to BNP Paribas, silver's explosive move began in mid-December, driven by a perfect storm of physical market disruptions. Here were the key catalysts. India's decision to collateralize silver, growing fears of Chinese export restrictions, US tariff threats on critical minerals, and massive physical flows from Europe into the United States. All of this created a physical squeeze. Silver was being sucked out of the European market and pulled into the US. That tightened supply dramatically, and prices responded violently. Thin markets don't move gracefully. This is critical to understand. Silver is not gold. Gold is deep, liquid, and institutionally stable. Silver is thin. That means when money flows in, it explodes higher. But when money flows out, it can fall just as fast. BNP Paribas is not denying silver's strength. In fact, they openly say silver is likely headed to $100 per ounce. But what they're warning about is what comes after. The first crack appeared last week. According to David Wilson, the first real crack appeared when the White House announced that critical mineral tariffs were not happening yet. That single clarification triggered a 7% correction in silver prices. That tells you something. Silver wasn't just trading on fundamentals, it was trading on fear of restriction. When that fear eased, even temporarily, price reacted immediately. Silver is now riding gold's coattails. After that correction, silver didn't collapse. Why? Because gold kept climbing. Silver has since been leveraged higher by gold's safe haven bid. This is important. It means silver is currently dependent on gold's momentum, and dependence creates vulnerability. The physical market is easing, according to BNP Paribas. This is the most controversial part of the analysis. BNP Paribas claims the physical silver market is beginning to ease. Specifically, our lease rates are falling. Physical dislocations are fading. Some of the extreme tightness is dissipating. From their perspective, the panic phase may be passing. That doesn't mean silver collapses tomorrow, but it does mean risk is changing. Why $100 could become a profit-taking level. David Wilson was very clear on this point. He expects silver to hit $100 sooner rather than later. But he also suggested that $100 may be where profit-taking begins. And in a thin market, profit-taking can be violent, especially when speculative flows decide to exit all at once. This sets up a very different path than gold. And this is the key takeaway from part one. Gold and silver are not being driven by the same forces anymore. Gold is being driven by systemic uncertainty. Silver was driven by physical dislocation and fear. Those are not the same thing, which means their paths may diverge sharply after silver reaches triple digits. The big question going forward. So the real question becomes, is silver simply overheating? Or is BNP Paribas underestimating how deep the structural issues still run? That's exactly what we're going to explore in part two. Because the next phase for silver depends on whether physical tightness truly resolves, whether speculative flows dominate, and whether gold's move pulls silver higher anyway. In part two, we'll break down shows of weakness versus false signals, why $100 could be a ceiling or a launchpad, and how smart money likely positions from here. This story is far from over, and the most important part comes next. So now we arrive at the real question. If gold is heading toward $5,000 on sustained uncertainty, and silver is racing toward $100 on momentum, what happens after silver gets there? Is $100 the end of the move, or is it just the beginning of something much larger? BNP Paribas believes it could be a turning point, but markets rarely follow clean narratives, and this is where context matters more than headlines. Why $100 matters? So much for silver. $100 isn't just a round number, it's psychological, it's symbolic, it's where everyone is watching. For traders, it's a take-profit level. For institutions, it's a stress test. For the public, it's confirmation that something is wrong. In thin markets like silver, that combination is dangerous because once a price becomes too obvious, behavior changes. The thin market problem revisited. Remember what BNP Paribas emphasized, silver is a much thinner market than gold. That means two things. Upside moves are exaggerated. Downside moves can be just as violent. When speculative money floods in, price explodes. When that same money exits, even partially, liquidity disappears and price gaps lower. This is why BNP Paribas is cautious after $100, not before it. The role of speculative flows. Silver's rally since mid-December has attracted massive speculative interest. Not long-term industrial buyers, not slow-moving central banks, but fast money, momentum traders, short-term funds, leverage-driven positioning. That money doesn't marry silver, it dates it. And when the relationship changes, it leaves quickly. Why lease rates matter more than headlines. One of the key signals BNP Paribas is watching is lease rates. Lease rates tell you how desperate the market is for physical metal. When lease rates spike, it means silver is scarce right now. When lease rates fall, pressure is easing. According to BNP Paribas, lease rates are dropping sharply. That suggests immediate panic is cooling. And cooling panic changes price behavior. This does not mean the bull market is over. This is critical. BNP Paribas is not saying silver is done. They're saying the character of the move may change, from panic-driven to consolidation-driven, from vertical to volatile, from one-way to two-way. That's not bearish. That's transitionary. Silver's dual personality problem. Silver has always suffered from an identity crisis. Is it a monetary metal or an industrial metal? During rallies, it tries to be both. During pullbacks, that dual role creates confusion. Gold doesn't have this problem. Gold is a monetary asset. Silver is monetary and functional. That makes silver more emotional and more erratic. Why gold may continue while silver pauses. This is where BNP Paribas' thesis really separates the two metals. Gold's drivers are macro and institutional, policy uncertainty, Fed credibility, currency debasement, geopolitical stress. Those don't resolve quickly. Silver's drivers were physical bottlenecks and policy fears. Some of those are already easing, so it's entirely possible that gold continues grinding higher. While silver pauses, corrects, or consolidates, that divergence would confuse a lot of people, but it wouldn't be unusual. The danger of narrative whiplash. Here's the real risk for retail investors. Silver bulls have been right, very right, but markets punish certainty. When everyone believes silver can only go up, that's usually when volatility returns. BNP Paribas is essentially warning, don't confuse a powerful rally with a straight line. Why corrections don't kill bull markets? Let's be very clear. Corrections are not failures. They're reset mechanisms. They shake out leverage. They remove weak hands. They rebuild structure. If silver corrects after $100, that doesn't invalidate the long-term case. It strengthens it, as long as the macro backdrop remains intact. The macro backdrop has not gone away, and this is where silver bulls still have ammunition, because the big picture hasn't changed. Inflation remains sticky. The dollar remains vulnerable. Debt levels are still extreme. Geopolitical risk is rising, not falling. Even BNP Paribas acknowledges that silver's longer-term demand story remains strong, especially from solar, electrification, and defense. Those trends don't reverse overnight. Why timing matters more than direction. The mistake most people make is focusing on direction only, up or down. But markets care more about timing and positioning. Buying strength blindly is risky. Selling fear blindly is also risky. BNP Paribas' message isn't sell silver, it's understand where you are in the cycle. What smart money likely does. Next. Here's what typically happens in markets like this. Early buyers take partial profits. Late buyers panic on pullbacks. Institutions wait for volatility to settle. Then accumulation resumes at higher lows. Silver may need to breathe. Gold may not. That's the nuance. The bigger lesson from BNP Paribas. The most important takeaway from this entire analysis isn't a price target. It's how institutions think. They don't trade narratives. They trade risk regimes. Right now, gold is in a risk regime that favors continuation. Silver is in a risk regime that favors volatility. Those are very different environments. Final thought. Don't confuse speed with sustainability. Silver's rally has been breathtaking, historic, but speed always demands respect. BNP Paribas isn't calling the top. They're calling attention to structure, and structure matters more than emotion. Closing message. Gold's move toward $5,000 is about trust. Silver's move toward $100 is about tension. What comes next depends on how that tension resolves, and whether fear returns or transforms into something deeper. This is not the end of the silver story. It's the point where discipline matters most.